All right, good morning, everyone. It is 9:43 on the morning of January 6th, 2023, and this is my pre-market strategy session. So, the title of today's video is Lighter Wage Gains Equals Less Hawkish Fed, and the 10-2 inversion looms. So, here we are, and the headline here is Dow gains more than 300 points after jobs report shows lighter wage gains than expected. So that's the Dow. I've got the Qs up, and the Qs are tech. So, the industrials versus tech, they can be two different stories. However, the three main markets being the S&P, the Dow, and the Qs, the NASDAQ, they all still move rather similarly. I guess the only difference is magnitude, where the S&P hasn't gotten hit as badly as the Qs have, but the charts still look very similar anyway. And so what we've got going on here today is the news came out at 8:30 this morning, of course, that the wage gains, let's see, U.S. stocks rose Friday when the December jobs report showed that employment was only slightly stronger and wage gains were less than expected, showing some signs of progress amid the Federal Reserve's interest rate hikes to tame inflation. All right, and so that's basically the deal, right? So if inflation is starting to come down, then the Fed can be less hawkish, and the whole deal with investing, really how to organize a portfolio, is basically front running the Fed, and the Fed does signal its intentions ahead of time, so that everybody knows. I mean, they make it really quite plainly known, explicitly stated, what their intentions are from quarter to quarter, month to month, quarter to quarter, and so on. And so even though the Fed is less hawkish, they are still in a they are in an environment where they'll continue to raise rates. So I was short-term bullish, expecting Wall Street to really kind of react to these recent data numbers that are, that could be considered catalysts for the Fed being less hawkish. However, in an environment where they are raising rates, they're still raising rates, And another thing, too, is that this 10-year, 2-year inversion, this is the monthly chart. This is the 10-year yield minus the 2-year yield. And you can see here this pink line is zero, where the two yields match. And then anything below this pink line is where the 2-year yield is yielding more than the 10-year. Essentially, the inversion, the deeper the inversion goes and the longer the inversion stays, the longer it stays inverted, the worse the economic scenario is going to be. And so this is what I'm saying with the 10-year, 2-year looming. When this normalizes, when this goes back up above zero and then kind of shoots off like this right here, like you see in 2008 and 2001 into 2002, those are the crashes. That's where the crashes happen. Here we are. We're 7 months into an inversion that historically has lasted anywhere between 12 and 18 months. So we're still, if history is any guide, we're still somewhere around 5 to 11 months away from this yield curve, this portion of the yield curve, the 10-2, normalizing and us getting a big crash. So in the meantime, though, things can remain bullish. Now, I was thinking, so, and I still am in this camp, and I mean, we'll have to see how it plays out. Let me get volume out of the way here real quick. We had a low back here on October 13th, and then we had another higher low on around the 4th of November, roughly. And now, technically speaking, this low right here at 259.73 is still higher than the low that was put in back here in the beginning of November. And actually, you know what? Let me see something here real quick. Let me click on this line. On closing, I forgot, on a closing basis, let's see, we closed at snap 2. We closed at 260.10 back here on the 3rd of November. Let's see, the close on the 28th of December was 260.10. What a coincidence. Wow. Huh. So we touched off of that closing low right there. Back here, same exact closing low. That is really quite a coincidence right there. 260 seems to be a line in the sand for the time being. And let's see where we are right now. We are at 261.14. Well, so the next leg down, if it happens, 260.10 is the number here. Really hard to say. I'd love to be bullish, but it looks as though I'm not going to be able to do that right now. I need to see what's going to play out, because a breakdown below 260.10 right here today would be it would really start to sink pretty quickly. If we get a breakdown here, it'll start crashing from this point right here, because technically speaking, this closing low back here, actually there wasn't a close back here. The close, look at this the bottom of this green candle right here, that's an open, that's not on a close. Let's see what the bottom is right here. That is 260.43. So we are really close to, actually let me do that again. 260.14. Yeah, so that just above 260 is the line in the sand right there. Breakdown below that today would put us in for some much lower prices, especially close below it. I would put us in for some much lower prices. The bottom line here, this is a neckline that was put in from a head and shoulders pattern from over a year ago now. That typically speaking, this is the direction, this is the trend until things break up again. This neckline, this bottom red line right here is the trend. So today could get really ugly. If this 260 doesn't hold, it's looking like the next real sort of point of resistance is going to be down here at 237 roughly. So I don't have a bias today. I'm just going to go with the chart that's in front of me. If we start breaking down below 260 roughly and retest that breakdown, then I will be very bearish today. And that is definitely, a harbinger for when this normalizes again. If it starts to crash from, 6 months out. Let's look at 6 months out here real quick. Let me go to the monthly. So let's see, 1, 2, 3, 4, 5, 6. If it's 6 months out, we're at 205 on the NASDAQ, and we get the crash, and that'll take us back to some really rather historically low prices. I've got a Fibonacci on this thing. Let's take a look at that real quick. Get rid of that brush mark. Let's move all this stuff out of the way. It's actually, I'll leave that trend line up. And here's my Fibonacci. So the zero, or the start point that I have here, is the low that was put back in September of 02, And here's the high that was put in. Was that November of 2021? November of 2021. That's my Fibonacci there, and see the 50% line is at 214. Wow. And we've already gotten a bounce off of the 62.8 right here that didn't really quite make it back up to the 75% level. I mean, gee whiz, if we start crashing, from these levels, let's go 1, 2, 3, 4, 5, 6 months out. We could be, 216 in 6 months on this thing. That's crazy. But that's the way it's looking right now, man. All right, so yeah, let me go back to the daily. I think there is still a little bit more time until we start breaking down. I would expect to see another leg up just to clear out the markets of all the bears, anybody who's speculating to the downside, but it doesn't have to happen that way. And I expect to see a leg up before the inversion normalizes, or before the yield curve normalizes again, but it doesn't have to happen that way. Yeesh. All right, well, yeah, today I will be looking for my opportunities to go short on the Qs. And when exactly that is, I'm not sure. Let's see. As of right now, we're coming out of oversold on the 1 minute. The 10 minute hasn't gone into oversold yet. On the VIX, we're going toward oversold, coming out of oversold on the 10 minute. So when things are discombobulated like this, when none of the charts line up, the overall trend tends to be what holds what it stays. So yeah, it looks like if I get an indicator where my relative strength is coming out of oversold at the same time the VIX or the Qs are coming out of overbought at the same time the VIX is coming out of oversold, that is a short opportunity. So nothing's lining up right now, so I have to wait for it to line up. Yeah, I don't know. I'm just going to kind of sit back and sit tight. I really am anticipating a move off the bottom here to the upside, but I can't do anything about that until it starts to break up above certain levels, which seems kind of counterintuitive. I'd say above, as of right now, above 270, and I'll look for a retest and then a buy after the retest. Below 260 and a retest, and I'm bearish. And so that's pretty much all I can do is just trade the chart that's in front of me with my indicators and stick to my system. And that's about it. So today, I don't know, might be a light trading day. If I don't, if the opportunity doesn't present itself, then it doesn't present itself. So, all right, everybody, good luck out there. Keep your wrists tight. Click like, share, subscribe. Leave a comment, tap the bell. Thanks for tuning in. I'll see you on Monday morning. Have a great weekend, everyone. I am out.